So behind me is the Bank of England, Britain's central bank. So what is a central bank and where do they get their money from? So the Bank of England was founded in 1694 and it's actually the 6th oldest bank in the world. Now whilst traditionally it's been seen as a bank storing gold and other assets, today it's responsible for setting the monetary policy of the British economy. What that means in practice is using interest rates, quantitative tightening and quantitative loosening, as well as capital reserves and liquidity ratios to control the supply of money in the British economy. Quantitative easing we've heard quite a lot about in recent times. Just recently, the Bank of England purchased £65 billion worth of bonds in order to stabilise the pension markets. Similarly, during COVID and in the wake of the 2008 financial crash, the Bank of England embarked on massive bond buying programmes. So where's all this money coming from for them to be able to buy these bonds? So the Bank of England is independent of the government in the United Kingdom, and that means it has an independent source of finances. Part of these assets have been acquired over the years and years that the bank has been around, but they do have access to regular cash flow. And that cash flow comes from several places. The most obvious of these is actually banknotes, because the Bank of England, unlike the Federal Reserve, print their own banknotes. In the US, the Federal Reserve isn't responsible for that. That is the purview of the Treasury. And a fun fact for you, the only crimes at the federal level that you can be executed for are murder, terrorism, and forgery, because that's how important the supply of money is to global economies. So a significant portion of the bank's money comes from the selling of banknotes, which cost them a couple of pence to create and make, but makes them the face value when they sell them to commercial and high street banks. The Bank of England also receive money from banks and commercial institutions and financial institutions paying into the bank in order to be part of certain schemes and also to maintain their capital ratio. So when the capital ratio is paid in, the bank hold that capital ratio, and in the meantime they're able to invest that, and that gets a source of income. They also provide banking services to the British government, but also to foreign overseas governments as well. And of course they charge a fee for that. And remember, all of the bonds that the bank hold, because they bought them from quantitative easing, go onto their asset books. So they're an asset that the bank can hold, and then they can sell them and recoup that money, and that is their money. So what this means is, on average, the Bank of England give back over £400 million worth of profit to the Treasury every year. So to a certain extent, the bank finances itself, so it's spending its own money rather than necessarily spending taxpayers' money. But with all economic decisions, there is of course opportunity cost to consider. So whilst the bank is wholly owned by the government and it has its own finances, those finances could be owned, for example, by the government, and they could be used and spent in a different way. Now, I'm not saying that's good or bad. Obviously, monetary stability is very important to the country's economy. But what do you guys think? Let me know in the comments down below. So thanks for watching, guys. I hope you've enjoyed the video. Please consider supporting me on Patreon, and I'll see you all in another video.